Okay, we're live. Good things come to those who wait. And those of you guys that are waiting on live, thank you so much for your patience. So good. Thank you so much for being here because I promise you it's going to be worth it. This is actually an encore presentation we're doing with Devin here because Devin's with TaxHive. If you guys haven't seen them before, we actually had TaxHive Devin on just a few weeks back. It was such a big hit with so many of you guys. We wanted to bring him back on for one more time before the end of the year because this is really like your not even your 2-minute warning, guys. This is like your 1-minute warning when it comes to the game here, because really there's almost no time at all if you're going to do some tax savings for the end of the year. So I want to make sure we brought Devin on once more just to be able to, not just present this and kind of give you some good tips and whatnot, but also be able to answer some of your questions, possibly even give you some good things that could save you thousands of dollars before the end of this year in taxes. So Devin, so glad to have you back on, man.
Yeah. So Chris, I don't know. Can you still hear me okay?
I can hear you. Yep.
Okay, awesome. Yeah. So my computer cut out there, I think, right as you made this transition. So if we're ready to jump in and knock this out, just thank you so much for having us on. We greatly appreciate the relationship with Chris and obviously Money Ripples. Chris, you were here at our office just last week and spoke to a large group of business owners. And just kudos to you, man. You always bring such an incredible energy to the stage and so captivating and such high value content and information. So love what you guys do at Money Ripples and grateful for this opportunity to speak to your audience. So if you're good on your end, I can share my screen and we'll jump right into this fun, exciting topic because everyone's on the edge of their seat about taxes, right?
That's right. Yeah. Let's hear it, man. Let's go for it.
All right, beautiful. So I'm just going to click present here and go ahead and share screen, hit this window, and bam, here we go. So you should see the Bald Brothers here. This is me and Kevin. Maybe Chris, can you give me an affirmation? You see me and Kevin here on the screen. Are we good?
We're awesome. Good.
All right, perfect. So I'm grateful to be with everyone and thankful for our relationship with Kevin. So Kevin is an equity partner in TaxHive. I film with him monthly, sometimes go down to his place in Miami. And I just want to emphasize, this is a Kevin O'Leary company. So he's not just a spokesperson, he's an actual equity owner. And what we do here at TaxHive, I feel like, is super unique. There's not a lot of other people in the marketplace doing what we do and specializing in what we specialize in. And I'll just to make sure that we're all on the same page. If anybody wants to participate in the comments section, you can. A lot of my questions will kind of be rhetorical, but just to make sure we're all on the same page. Does anybody not pay taxes? And that's usually the response I'm looking for, utter silence, right? Which most presenters get up and are like, hey, I'm going to ask a question that everyone says yes to. I wanted everyone to just acknowledge we're all taxpayers in some form or fashion. And you might say, well, hey, Devin, I actually don't pay much in income tax because I have a lot of offsetting expenses or deductions. But at the end of the day, you and I are paying a lot of money in taxes. And I want to talk a little bit about that. I mean, how much are you paying? Like, if I were to put a number on the screen, what do you think the realistic number is? What do you and I pay in taxes? That's the question that I want to ask. How much do you pay? And you can think about it again, just kind of internally. What do I pay? And usually what I get from people is they say way too much, or they say, 20% or 30%. And usually what happens is your mind immediately goes to income tax. Right? When I asked the question, how much do you pay? You immediately thought, how much do I pay in income tax? Well, income tax, unfortunately for you and I, is not the only tax that you and I pay. We pay sales tax. For those of you that own property, you pay property tax. And some of you might be in states where you're like, we don't pay property tax or we don't pay state income tax. Well, then you've got toll roads or you've got some other way, right, that your local and federal government is getting their share. And it's oftentimes not a fair share when you stack it up alongside everything else that you do, right? You're taxed when you earn it. You're taxed when you buy it. You're taxed while you own it. You're taxed when you sell it. In the case of healthcare, you're taxed if you don't buy it. I mean, just look at your gas bill, your phone bill, anything you and I do, we are taxed left and right. And guess what? Most of the taxes that you and I pay we can do nothing about. Like, just quick example, if I'm at Harmon's buying some groceries, I can't tell the cashier, hold on, I don't pay sales tax because look, I have dependents. This is my 9-year-old, 5-year-old, 3-year-old, and 1-year-old. I'm a father of 4, but those deductions, right, those dependents are not applicable to sales tax. The only tax that you and I pay that is negotiable or that we can do anything about is our income tax, both on a corporate and on an individual level. And so before I get into the weeds on specific strategy and showing you some really cool cutting edge things that all of you should be thinking about to reduce your tax burden, I need to wake you up. Like, I need to reach through the screen, and I'm not going to slap you across the face, but I am going to maybe just kind of shake you a little bit to say, hey, real quick, you need to tune in. You need to put away your distractions, because if you don't fix your tax problem, odds are that your income will never be enough. Your income, if you don't fix the tax problem, will never add up to the number that you want it to add up to. And here is exactly why. So the illustration that's on the screen right now is a dollar that gets doubled every single year. And when we double our money at the end of 10 years, we're at $1,000. Okay, no big deal. Most of you think, Devin, it doesn't take me 10 years to accumulate $1,000. Okay, well, then your numbers are going to be even bigger than this. But nonetheless, power of compounding, growing money over time, that's what business owners do, right? If you talk to Chris, right, and self-banking, it's all about growing that nest egg and being wise about how we do it. Well, in this situation of growing our money, if you then expand to the next 10 years and you go out to the 20-year mark, well, then congratulations, you now have $1 million. But we did this all with what? With no tax. You can see it at the top of the screen. We weren't paying any tax. And I don't know what world you live in, but in the world I live in, that's not possible. That doesn't exist, right? Back in the day, Benjamin Franklin or someone said, hey, a penny saved is a penny earned. And it may have been true back then, but today, you and I typically need to hold on to, or we need to have $2 flow into our business just to keep one. So here's what I want to do. I want to talk to you about taxes and making just a subtle shift. It's probably impossible for anyone to go from, hey, Devin, I'm at a 40% tax bracket and I want to get to 0. Okay, well, maybe, like possibly, but let's try to be conservative. Let's be a little bit more realistic. And let's say, what if TaxHive was only able to make a 15% correction, a 15% improvement on your tax situation? Let's rerun this exact same scenario and look at the numbers to say, hey, right now I might be paying 15% more than I should. And here's what happens. So in the same 10 years, at the end of 10, instead of having $1,000, if you and I just simply introduce a 15% tax, well, then you now have half as much money at the end of 10 years. Instead of 1,000, you're at 469. Nobody's really mad about that until you fast forward to the next 10 years, which puts you at less than $250,000. Instead of $1 million, you now have $220,000 sitting in your bank account. And I want to ask the question, where did the money go? Like, if you guys can participate in the chat, or if there's another area for you to correspond with me, I'm interested to know, where do you guys think the money went? Like, did the government get it? Did your dog eat your homework? Like, where's the 800 grand? And usually what most people say is like, oh, Uncle Sam grabbed it. The IRS captured it. And that's usually how we feel when we look back at our bank account and we say, where did all my money go? Well, the reality is that the money actually never existed. It vanished from thin air because it never had the potential to grow. It never compounded, right? And in this illustration, as a business owner, as just an individual, if you keep less of your money, well, then that's less money that's being pumped into your investment portfolio, less money being utilized on self-banking, less money being energized into your marketing spend and your acquisition of, new locations or new goods or whatever it is that you sell. Doing it better and bigger is not possible because you have less money to operate with, less capital, right? And this is just a simple 15% illustration. So hopefully everyone now is kind of awake to the reality of their tax situation and saying, man, if I'm overpaying by just 15%, well, then in a span of 20 years, I'm probably missing out on some big, massive opportunities. And so how does TaxHive really supercharge tax savings for our clients? It's within these 4 pillars. It's deductions, which most of you are probably familiar with. It's strategic credits, it's tax gaps, and it's dynasty strategies. Now, many of you already may be thinking, well, hey, Devin, don't I already get this? Like, I have a CPA, I have an accountant. Don't they understand the tax code? Most of them understand tax compliance, but they're not experts at taking your current corporate structure, your geography, your revenue, and your industry and marrying that up to the 6,000 plus pages of tax code, right? So here, let me illustrate this a little bit further, because we get this response or this reaction quite often. And I want to be crystal clear. If you love who you're working with, odds are that's not the case. But if you genuinely love the CPA or accountant that you're working with, you've been working with them for decades, it's your aunt or your uncle, right? We're not expecting you to divorce yourself from them in order to work with us. We can work hand in hand with anyone that is your tax preparer. But that's the key right here. They are your tax preparer. They are checking boxes. They're inputting numbers into a sheet, and they're eventually just telling you what you owe, which might be a little bit of a clue in that you may ask yourself, who does this person really work for? Like, do they work for me, or are they working for the IRS? Are they a cashier for the IRS, or are they trying to help me minimize my tax burden? In most cases, these people are doing the exact job that you hired them to do, that you paid them to do, which is tax preparation and filing. What we're talking about here today is a completely separate discipline. It's something that most CPAs or accountants either know very little about, or that they don't really want to spend their time doing on your behalf. They have their system and their approach to their business, which is tax preparation, and they don't really delve into tax strategy, at least not to the depth and detail that we do here at TaxHive. We feel like this is the biggest game changer for most business owners and for most people like yourselves, high wage earners that want to pay less in taxes and do it legally. So if we look at these 4 pillars and we say, okay, hey, TaxHive is going to do some things for me that my current CPA or accountant isn't doing. What are those things, and how does that fit into the tax code? Are we doing it the right way? Well, I'm going to show you every pillar. I'm going to give you some specific examples in each one, but I like to get to the end. I'm one of those people that loves spoilers. Like, I like to know the ending as I watch the movie. It's kind of weird, but let's just fast forward to the dynasty strategies. Let's have a little bit of fun right out of the gates here. And let's talk about some big hits, like some stuff that is knocking it out of the park for clients on a big scale. These are not bunts or singles, right, in the game of baseball. These are some big savings. And to give you, just a quick high level on one example, in fact, a couple of dynasty strategies that everyone should maybe put in their notes. This would include solo 401ks, other strategic retirement accounts. This would include mineral deposits, oil and gas investments, cost segregation. There's a myriad of dynasty strategies that are hyper specialized. They sometimes include other investment, but as I'm about to show you, that investment would be made with dollars that would be sent off to the IRS instead of staying with you or staying with an investment vehicle. So we're not talking about taking new money out of your bank account. These are dollars that you would have already spent in taxes. So let me show you a quick strategy. This is called the accelerated strategy. Probably one that most of you have never heard about, or you've maybe seen something on Reddit or YouTube, but you didn't know enough about it to really implement it or quantify the opportunity. So watch this. Let's pretend for a second that you owe the IRS 100 grand. And I know what most of you are thinking. Hey, Devin, I would love it if I could only owe them 100 grand. And some of you are thinking, Devin, I'm not in that realm yet, but wherever you are, you can just kind of translate this over to numbers that fit for you. Let's pretend that you owe the IRS 100 grand right now. And you look left and you look right and you say, is there any better way? Is there a way that I can not send 100 grand off to them because I know it's going to get spent, in a really bad way? So here's what happens. Instead of the 100 grand, we're going to take 50 of it and we're going to donate it to an eligible nonprofit, a 501c3 that is eligible for this strategy that I'm about to show you. That it gives you a 4 to 6 times multiplier on your donation. This is not like donating to your local church. This isn't, a food bank of sorts. It'd be like something more substantial, more significant, like the Red Cross, some organization where the government has said, hey, we're in particular need, and if you're willing to make this donation, there's an accelerant on your deduction. So watch this. I grew up in the calculator days, so I like easy math. We make a $50,000 donation. Let's take the 5x multiplier. 5 times 50 is a $250,000 deduction. So time out a second, pause. We're not saving 250 grand. We're getting a $250,000 deduction, which then makes it so that we donated the 50 grand. We got the $250,000 deduction. We have to run the deduction through our tax bracket. So let's assume for a second that you're in a 32% tax bracket on your income. Well, that's that's a savings of $80,000. But again, pump the brakes, right? Pause, because we're not saving $80,000 here. We still made a $50,000 donation, which the net savings after our $50,000 donation, 80 minus the 50, is a $30,000 account balance, right? That is larger than it was before. Just by show of hands, how many of you'd rather have a $30,000 in your bank account instead of paying all of it to the IRS? So just by, further illustration here, we've now sent $20,000 to the IRS. It's what we legally owe. Good for you. Pat on the back, right? You're a great human being. You donated $50,000 to an eligible nonprofit, and then you kept $30,000 in your bank account that wasn't there a couple of minutes ago, right? This right here is a dynasty strategy. This is something we teach, something that we help our clients implement and document. We help you identify the opportunities out there in the landscape of nonprofits and 501c3s so that you're doing it all the right way. Now, this is one of those quick hits, but not everything is, a dynasty strategy. You've got deductions and credits and gaps. When you work with TaxHive, we summarize, but then also outline in detail every single deduction, credit, gap, and dynasty strategy that you're eligible for. And here's what a summary page of a tax plan looks like. This is an actual client. I actually know this guy. He's from Georgia, but for sake of privacy, I've redacted his information. Now, right here in this plan, you can see there's savings on an individual level. There's savings on his business, right? To the tune of almost $30,000 in savings. And I would argue that until you see these numbers, you maybe don't believe the strategy. You're not compelled to go and implement it because there's no dollar figure attached to it. That's the difference at TaxHive, is when we identify opportunities within the tax code, we have the ability to attach a number to it, to quantify it, to say, hey, yeah, if you go through the, inconvenience of documenting this or that, well, then here's what's on deck for you. Here's the reality of savings that could be discovered if you simply will document and implement the strategy properly. So I always like to show this because a lot of people think like, oh, this is just kind of some distant, philosophy about the tax code, and it's not really going to make a whole lot. No, we're going to drill this down to actual numbers of discovered savings for you. And what I would recommend that you do right out of the gates here, I'm not going to wait until the very end here. For those of you that can already kind of see some value, those of you that in the back of your mind know, I'm already overpaying. My CPA or accountant is not a strategist. I probably need to talk to somebody. Okay, well then great. Just scan this QR code, go to taxhive.com/breakout, and there's a free discovery call strategy session. You can schedule that call with our team, with one of our professionals, and we would just love on a one-on-one basis, assess your situation, do some analysis, and really give you an outlook of what is potentially, viable for you within the tax code. Does it even make sense? Is it the right fit to work with TaxHive in this endeavor? I can promise you that that call is going to be super valuable to you. And it's maybe a 10 or 15 minute conversation, discovery session, strategy session for us to really work through that. So I'll give you a second to kind of scan that QR code, go to taxhive.com/breakout, make sure that you get that scheduled. Our schedule right now, as the end of the year is approaching, is really getting stacked up. And so I'd highly recommend jumping on there and picking the time that is most convenient for you and your schedule. And then I'm going to show you this again at the end. There's no invitation here for you to, get out your American Express. Keep your wallet or your, credit cards in your purse or in your back pocket. I'm not asking for your money here today. I'm inviting you to have a conversation with our team, see if TaxHive is the right fit for what you and your strategy and what you're doing overall. So this is a question that we have asked over 86,000 business owners. And surprising, I guess, I don't know if it's totally surprising, but sadly, over 77% of them have said, no, I'm not confident that my accountant is maximizing all of the possible deductions for my business and keeping me compliant with the tax code. I don't know where to point the finger, right? Like maybe some of this is the responsibility of that individual or that business owner. A lot of it is probably on their tax preparer and accountant, but the gap in communication here is really at its core, I think, the problem. We are highly engaged with our clients. I mean, twice a week, we host an Ask a Tax Pro webinar where anyone at any time can ask one of our senior advisors any tax question about their scenario. And we do it in a webinar fashion. So find another CPA or accountant that twice a week is open to getting on a call with you and making sure that you understand the code and everything that's applicable to you. We've identified this massive gap in the marketplace. And when you click on that, QR code, when you go to taxhive.com/breakout, this is what you'll see. You're going to want to go to that blue button at the bottom. You could watch the video from Kevin if you'd like. We have a guarantee. If you spend some time with us, we can promise and warranty to you that we'll identify at least $10,000 of potential savings, or we give you $100. I mean, it's a super safe bet on our part, but nonetheless, we want to make it worth your time and a little bit of your risk of, hey, just am I going to take my calendar and schedule this time with TaxHive? Click that blue button. And at the end of the day, this just comes down to, are you willing to do something about your tax scenario? If you know you're overpaying, if you know your current CPA or accountant is a little bit, I don't want to say inept, but maybe just disengaged and a person of inaction, they're not doing a ton of strategy with you, well then, are you willing to do something about it? And this is your opportunity to do that. It's a small step in the right direction, and we'd love to help you with it. Now, Kevin would tell you, hey, he's a straight shooter, right? Kevin O'Leary's Shark Tank. He's just going to tell you, hey, shame on you if you don't plan for taxes. I take a little bit of a different approach and just say, hey, plan on paying more than you should if you don't plan for taxes. And tax planning, tax strategy is oftentimes, I think, misconstrued. People see it as a, Wesley Snipes, Al Capone strategy. Like, am I a tax evader? And it's like, whoa, no. This is what's already in the code. It's available to you. It's written into law. There is 70,000 plus pages of legislation interpreting this code to make sure that you take advantage of it the right way. You should be doing all of those things. It's money that you're entitled to. And right now, I can just tell you, like if my hand's using as a simple example, like over here on the left-hand side is the code. And over here on the right-hand side is where your current accountant has you processing and paying your taxes every single year. I don't know how close you are to the actual code. Most of you are probably out of screen, right? You're over here. And your accountant says, oh, well, yeah, all that stuff in the middle, like you don't really want to mess with that. It might, get you into hot water with the IRS. It's like, hold on a second. If it's in the code, if it's legal, and if I do it the right way, why are you afraid of it? Like, you're not going to tell me to do anything that's not compliant, right? Because that's not, that's what we're going to focus on doing it the compliant way here at TaxHive. The gap right here, the thing that I'm trying to emphasize, it's convenient for your CPA or accountant to not care about the gap. You know why? It's not their money. It's your money. And the reason that they are apathetic about it is because it's not their bank account at the end of the day. And so you've got to decide, hey, how close to the code should I get? And we'll advise you on that. We'll help you with that. But so long as you're on this side of it, right, you're doing it legally, you're documenting everything, then right now, like when we see a rare, super rare audit come through, these are not like full forensic audits. These are a knock at the door that says, and not even on the door, it's a letter that just says, hey, we'd like some documentation about Rule 280A, the Augusta rule that you implemented. Can you provide us that documentation? You provide it and say sayonara, and they're like, okay, good, thank you, I appreciate it. If you do things the right way, you have nothing to fear. You're in a defensible position, and we would stand by it. Now, what is the cost of doing nothing? right? Like you're on the other end of this call, you're listening to the bald guy here, and it's like, hey, Devin and TaxHive and Kevin O'Leary, I just don't know if I really want to take the time. No problem. Before you make that decision, let me show you the cost of doing nothing. This is the reality of what a business owner like yourself is paying or overpaying on an annual basis by not working with us. How do we know this number? It's because we've delivered thousands and thousands of tax plans to people just like you. And those tax plans, we can average out those savings based on business revenue. And here's the cost of doing nothing. If you scan your eyes along the bottom in black font, it says business revenue. And you can work your eyes left to right and then stop when you get to the revenue that you typically see on an annual basis, right? And then go upward, look up into the clouds, and you say, okay, hey, if I'm a $700,000 to $1 million business, then there's 70 to 100 grand in savings for me and my business if I just implement a tax plan, right? If I'm a little more strategic about this. And tax planning, as Chris mentioned, is an annual thing. It's not a daily event, but this is something you should be thinking about on a weekly, monthly, quarterly basis. And yes, we're approaching the end of 2024. Time is running out for you to do anything about this year. But hopefully 2025 is also a year plentiful with deductions, credits, gaps. And I hope that all of you, most of you, should be planning on your best year ever coming up in 2025, right? So wherever you fit into this bucket, this is the cost of doing nothing. It's the cost of just doing what most people do, right? The old way of taxes and working with a CPA is having them be your tax preparer, and that's it. The new way is working with someone who's strategic, who does the analysis, who takes the time and the energy to be a pro about this and actually identify the opportunities within the code. Which brings me to my next point. I want to be clear about who Uncle Sam is and what their role is and why would they create the tax code. Well, the tax code sometimes feels like your enemy, but in reality, the tax code was written specifically to incentivize behavior that the government wants. What is that behavior? They want entrepreneurship. They want risk taking. They want you to take your capital and put it to work. They want your intellectual property to generate jobs and to, infuse all kinds of economic value into our economy. And it's because they know that small business owners make up 2/3 of the jobs in this country, that over 40% of the economic activity that happens in this country is attributed to small business owners. And so they've said, hey, here's an ethical bribe. If you're willing to take the risk, if you're willing to employ other people and be a contributor to the economy, well, then we'll give you some tax breaks, right? You scratch my back, I'll shave yours. I don't know if that's the analogy or not, but nonetheless, the government is willing to make this trade with you. And the IRS sometimes gets a bad kind of connotation to it because people think that it's a money grab, and I don't know how everyone feels about it. I have certainly my opinions, but call it this. The IRS is the world's largest debt collection agency. They want to get every penny that they are owed, but not a penny more. Their job is to collect their money. And if you can document and utilize the code to your favor, well, then they don't expect you to pay $1 more than that, right? And you should be utilizing it to its full capacity, which brings me to this, which is, hey, when do you want to pay taxes? If you're a W-2 person, then you pay now, right? In fact, maybe even before now, like they strip it out of your check before it ever gets deposited into your account is when you pay taxes. But which of these scenarios do you like the best? Do you like paying taxes now, later, or never? And I know if some of you silently are like, I don't know if I can raise my hand on this one, but I'm going to go with never, but I'm not going to say it out loud in case someone's listening, right? And never is, I think, the right answer. Everyone should prefer that at least. But how do you pay never? Is that even possible? And one time in one of my environments like this, actually it was a live setting, I asked the audience, hey, so how do you pay never? And this guy shouted out, don't make any money. And okay, that's a true answer, but it's a horrible goal, right? How much money do you want to make? Should be all of it, right? I don't know how much that is, but you should want to make as much money as you can. But how do you make $1 and never pay any tax on it. And to some people, right, this sounds like the handcuff strategy. Is this the Al Capone, Wesley Snipes approach, or is this doing things legally by the book with precedent, right? All of our tax advisors signing off on what we deliver in a plan. The only way for you to pay never, right, is for you to take advantage of these 4 pillars: deductions, credits, gaps, and dynasty strategies. I already showed you one dynasty strategy. Let's get into some of the blocking and tackling, some of the more basic stuff with maximizing deductions. I'm not going to bore you. Most of you already know about a home office deduction. Most of you already know that you can have a corporate vehicle and, write off your mileage or your expenses related to that. Most of you know that you could, hire your dependents and have your children and pay them wages on an annual basis up to a certain amount that is tax free. The deductions are easy, actually. That's the mortgage interest and a handful of other things. Well, guess what? There are a lot of other deductions that you know nothing about. You've never heard of them. You've never implemented them. You know why? There are over 1,400 of them. Like, good luck, right? You and I are focused on our businesses. We're focused on our families and our hobbies. We're not reading the tax code every night. So this is why TaxHive exists. This is why you do a free strategy call to say, what is the potential that's out there for me in my business? Could I unlock, how do I stack up my deductions so that I minimize my tax burden as much as possible? I'm going to show you some real client examples here in just a second. We're also going to talk about strategic credits and tax gaps. I want to be clear, though, about what TaxHive or who we are, right? We're an advisory firm. It's in bigger, bolder letters because at the end of the day, you can find just about anyone out of the yellow pages if it still exists. You can go Google a CPA or accountant, dime a dozen, not hard to find, right? TurboTax, H&R Block, you get what you pay for. But nonetheless, if you're looking for tax preparation, bookkeeping, someone to file for you, that's not hard to do. We do those things. We do it in addition to tax planning. And it's usually for people that are dissatisfied with the person they've been working with. If you love who you've been working with, great, keep working with them. But we're going to advise you prior to sitting down with them and delivering all of your documents and facts and circumstances to them so that when you meet with the tax preparer you love, you owe less. That's a better scenario, and that's what we're happy to do on your behalf. Our advisory services, our strategic tax planning is what sets us apart. This is, forgive the analogy, but this is a little bit quick story for you. I went and got my teeth checked the other day. I love my pearly whites. I'm obsessed with hygiene. I floss after every meal. I'm brushing 3 times a day. Maybe that's too often. I don't know. But I hate cavities and I hate going to the dentist. Well, when I went recently, there's the hygienist and then there's the dentist. And the hygienist, well, he polished my teeth. He cleaned my teeth. Well, the dentist rolls in and she's doing the forensics. She's got the x-ray. She's got her fine tooth, all kinds of tools and things that she's inspecting and picking at. You know what she's looking for? Cavities. She's looking for the gaps. She's looking for the missing parts of my teeth that need to be filled, right? The same is true between tax preparation and tax strategy, tax planning. Tax preparation is a lot like the hygienist doing some of your cleaning or polishing, but it's not the forensics work. It's not the analysis that you need done to ensure that you've uncovered every cavity and you've filled those holes and you've maximized your savings. So, when you work with TaxHive, are we reputable? Of course. Kevin O'Leary wouldn't be an equity partner if that weren't the case. So I'm not going to bore you with this, but A+ rated with the Better Business Bureau. We've got Trustpilot reviews falling out of our ears, over a couple thousand Google reviews. You'd be welcome to come see our offices here in Orem. I'm not going to bore you with the 5-star reviews. You know this. We're not perfect. The gap between a 4.6 out of 5 and a perfect 5 is just that we're a business of human beings. We're not perfect, and we're not going to pretend to be. But I can promise you this. If we ever misstep for someone, we use those as opportunities to over-deliver for our clients. And on a large scale, we're knocking it out of the park for people. So let's talk a little bit about deductions, and let me show you some real examples. This right here is Carrie. She has a notary business. Her tax plan with us, over $28,000 of discovered savings. Carrie's tax plan included a myriad of deductions as well as tax gaps that I want to talk to you about. There was one in there that included just a simple modification to Carrie's corporate structure. It's what's called an S election. It avoids double taxation. It gives you the proper corporate structure that you need to minimize your tax burden. You avoid self-employment tax. There's a number of things there, but you may be noticing, hey, over 5 years, holy cow, Carrie would capture potentially $140,000 of tax savings if she implements the plan to its full scope. Well, that's actually not the most, I think, revealing part of this slide. Do you notice anything else? Anything else stick out to you? For me, it's the years in business. 20 years. 20, you guys, 2 decades. How much money was lost? And I don't know about you, but you probably plan on being in business for the next 3 to 5, 10, maybe 15 or 20 years. And are you going to continue to overpay? And what is the compounding cost of overpaying? What opportunity are you missing out on by overpaying every single? That's the part of this slide that I think for Carrie was probably most revealing to her as well. This is a commercial cleaning business, Astrid out of Missouri. Now, I show this to be ultra conservative and to say, hey, do we find tax plans where there's $10,000 or so of identified savings? Yes. Are those numbers insignificant? I don't know, maybe for some of you, but I like $10,000. I don't know about you. I'll bet for Astrid, the $10,000 matters. For a commercial cleaning business, depending on how small you are, you could probably argue if Astrid's doing, his or her first $150,000 in gross revenue, well, then this $10,000 could be the difference between making payroll or having a marketing budget, going or staying out of business, right? Staying in business or going out of business. These dollars matter, whether they're 10,000 or a couple $100,000. And in Astrid's tax plan, similar deductions to Carrie's, but I don't think that I think the S election was already taken care of for Astrid. Astrid also had what we like to call the Augusta rule. It's a Rule 280A, and maybe just grab a fresh sheet of notes real quickly before I transition over to strategic credits. Let's just call a timeout, and I want to talk to you about Rule 280A. This is another quick hit. Did you know? And to give you the full background, I don't know if we have time. You can go look it up. It's called the Augusta rule because a lot of people rumor that there are property owners near Augusta National where the Masters, the biggest golf tournament in the world, takes place. And for 2 weeks out of the year, you can rent your home out for top dollar. And guess what? Some of those people maybe had a phone number to a lobbyist who knew a legislator who could alter the tax code and get a bill passed to say, yeah, hey, guess what? You can rent your home out for up to 14 days or nights a year and do it, guess what? Tax free. Sounds crazy, right? It's in the code. Rule 280-A. Rule 280A, also known as the Augusta rule. The IRS doesn't like it to be called that. But the Augusta rule says up to 14 times a year, you can rent your home out to your business for a business purpose, invoice your business personally. The expense to your business is deductible. The income to you on an individual level is tax-free. Is that insane or what? 14 days, you have to actually host a meeting. This can't be a pretend, Zoom call. You have to actually do something, have a business purpose. You got to take notes. You have to actually invoice your business. You have to charge your business a reasonable rate. But all of these things are applicable to you as a business owner. You all right now could generate an extra $10,000 to $15,000 in income on an individual level from your business and have it be tax-free and also have it be a deduction to your business as an expense. So critical stuff. Now, on these strategic credits, I want to be really clear here. The employee retention credit, the ERC credit, is what really put credits back on the map. There was a little while there where people were like, credits, I've never really heard of it. Are credits a real thing? Everyone knows about the employee retention credit, right? Hey, COVID hit. The government came on their knees pleading, please, don't fire your people. Just keep them on payroll, keep paying their wages, and we'll subsidize it. We'll pay their wages with a tax credit. The employee retention credit put these credits back on the map. This tree service, Sean out of Florida, his tax plan included the work opportunity tax credit. Hey, guess what? In certain geographies and for certain individuals, If you employ them, there's a work opportunity tax credit that gives you tax savings. There's also this vehicle plug-in credit. No surprise, going solar, going green in the age of climate, whatever you want to call it, there are tax incentives that allow you to pay less, get credits if you install EV chargers, if you go solar on your place of business, on your personal residence, all kinds of solar credits out there. Matthew and his group in Virginia have the same thing. This R&D tax credit, Elias and his energy sector group out of California had the research and development tax credit part of their plan. The research and development tax credit simply says something along these lines. Hey, if you're in a certain industry, and if you're doing research and development, discovering, innovating, well, then the equipment that takes or the personnel that takes can be subsidized, paid via credits from the government for being innovative and for being part of a research and development project. Now, when I show these things, oftentimes people think automatically, oh yeah, Devin, like the R&D tax credit, that's like SpaceX, that's Elon Musk and Tesla. And no. Like Warren Buffett, Jeff Bezos, Michael Bloomberg, none of these guys have their names specifically listed in the code. What are they? They're business owners, and they are therefore eligible for these deductions, credits, gaps, and dynasty strategies. They may have a better team than you have, but the code is not, partial to them. You and I are the same. We're human beings. If we are business owners and we're risking our capital out there in the marketplace, we can take advantage of the same things that they do, just maybe on a different scale, right? Here's the difference. These gentlemen and ladies that are millions and, multi-million and billionaires, they have advisors. They have teams of people that are doing this for them on a daily basis. Who's going to provide that to you and I, who are smaller business owners? We might be doing millions and millions in revenue, but nonetheless, we're a smaller fish in a very big pond. That's what TaxHive specializes in. We've brought this high level of expertise and delivered it to the small business owner at scale. So let's dive into tax gaps. This gets really fun. Now, Alva and Alva's business, real estate broker out of Kentucky, over $26,000 of identified savings in Alva's tax plan. Alva's tax plan had some bonus depreciation, had some S-Corp election, had some Augusta rule in there, other deductions as well. The gaps oftentimes are this misnomer of like, oh, they're loopholes. No, loophole is just code for I don't understand it and I don't really, it doesn't apply to me. And so I want to scrutinize someone who's taking advantage of something that's legal. There are really no loopholes. Loopholes are just gaps. They're parts of the code that allow you and I to get credits, discounts, and savings on what we owe the government, but we do it legally, right? This massage therapy business, Tamlin out of Texas, over $16,000 of potential savings in her tax plan. It had similar things in there as the other ones that I've listed. But here's the thing. Every tax plan is just a little bit different. Everyone is in a different geography. Everyone has a slightly different corporate structure, different industries, different revenue volumes and types, right? If you're doing your first couple $100,000 in gross revenue, well, then we're not going to come to you with a really hefty dynasty strategy that's going to require, substantial investment. If you're a $10 million plus business, well, then you can probably take some of those bigger hits. And so every plan is going to be different and customized to you. We talked a little bit about these dynasty strategies. For anyone that jumped on the call a little bit late, let me show you again the strategy that we discussed, which was this accelerated donation strategy, where instead of sending $100,000 to the IRS, we sent $20,000. We did it with a vehicle known as the accelerated donation strategy, where we donated $50,000 to an eligible nonprofit. We got a $250,000 deduction because of the multiplier, the accelerator that happens on that donation. And when you run that $250,000 deduction through a 32% tax bracket, you end up with an $80,000 savings, except we donated $50,000, which results in a $30,000 net savings to your bottom line, to your bank account. I know all of you are thinking, I need that. I would love to have that as part of my tax strategy. And you know what's happening right now? Your accountant, your CPA, is asleep at the wheel. I had an old friend of mine that was all about little sayings. I don't know if he was a farmer or what, but he'd oftentimes say, the wheel is spinning, but the hamster's dead, right? Like that's a little bit of the circumstance that your current CPA or accountant is in. They're just not thinking about these things. They're not being proactive with you. And in most cases, they actually don't understand it. They're not experts in the code. They're experts in tax preparation and in crunching numbers. We are strategists. We'll do the forensics, we'll do the analysis, and we will save you a ton of money. Now, this group out of Georgia, Veterans Disability Assistance business, over $29,000 of identified savings. That's $147,000 over the next 5 years. Again, this business, bonus depreciation, I think some not R&D, it was oil and gas investment, Augusta rule, other itemized deductions. But that $29,000 matters, no doubt about it. This moving company out of Utah, 8 years in business, over $73,000 of potential savings for Jared and his moving company. $73,000. And for everyone on this call, your savings is going to be a little bit different. But I know those dollars matter. And I showed you this up front. What's the cost of doing nothing? Or rather, what's the reward of having a phone call with TaxHive and taking some action and really taking control of your tax situation? This is it, right? Scan your eyes wherever you fit on this window. And again, if you're on the left-hand side with lower numbers, I think those numbers matter maybe even more significantly than the big numbers that you see off to the right. So we would love to earn the privilege to work with you, to service you, and to, deliver substantial, significant savings to your bottom line via a tax plan. Kevin O'Leary would tell you, hey, you work so hard to grow your business. Don't overpay on taxes. This is something that's well within your control. And maybe let me map it out this way, right? I'm a business owner. I'm the president here at TaxHive, but I'm also a small business owner. I actually own and operate the largest pickleball club in the country. It's called Club Pickleball USA. And I know how hard it is to grow a business. But if you grow the business, blood, sweat, and tears, and then you go and overpay unnecessarily on taxes, it's like, I can't even, like, I'm trying to think of it, it's almost like stabbing yourself in the back. But nonetheless, as a business owner, you have cost of goods, you have payroll, you have rent, you have your mortgage, you have any other, structured payment of costs of operating your business. And then the fifth one is taxes. And I would argue that taxes is the fastest way to give yourself a raise, to give you and your partners a better distribution, because you're not likely to go talk to your landlord and renegotiate a better lease rate. You're not likely to go to the bank and negotiate a lower interest rate, at least not right now with where interest rates are. Your cost of goods. Are you going to go to your wholesaler or your supplier and say, hey, I need to go from a 40% margin to a 70% margin overnight? It's not going to happen. And with your payroll, can you just hold a company meeting and say, hey, guys, we're going to cut everyone's pay by 20% because we want to add to the company's bottom line? It's not going to happen. But you know where you can have that kind of impact? Tax savings, tax strategy. And it's a quick hit, right? So are you willing to do something about it? You willing to take a chance on TaxHive? We would love the opportunity and the privilege to earn your business and have that discovery call with you. Have a strategy session that is no obligation, no expectation. It's simply, hey, let's learn a little bit about what you're doing. And based on our experience, here's what we typically find in savings for someone like yourself. And so I would just recommend going to this free strategy session. You can go to taxhive.com/taxes. In fact, I'm just going to click back real quickly to the QR code. That is oftentimes, sorry, I didn't have that on the last slide. This one right here is usually oftentimes easier with the QR code. Scan it. If you're on your phone, if you take a screenshot of that and then go to your albums, your phone is smart enough to read the QR code. You can click on the QR code and then it will populate the web browser for you to go schedule that call. taxhive.com/breakout, the QR code. Anywhere you go, you're going to get in touch with TaxHive, but we would really just love the opportunity to save you some money, add to your bottom line. And we feel like that's what the American dream is. It's not necessarily about how much money you make if you can't keep it, right? You got to be focused on keeping it and wealth preservation as much as you are focused on making it. So with that, I think any questions maybe in the chat, I will exit the screen share here, and maybe if anybody has any questions in the private chat. Chris, you're still with me. We're just under 50 minutes in. So anybody else have questions or comments that we can address while we're together?
Yeah, we had several coming in. Devin, quick question for you. Am I supposed to be presenting to your group 10 minutes ago?
I believe so. Yes. And
Okay.
Nate may be ready for you over there. So yes, we should probably jump over there, but let's do this. It looks like, wow,
There were
there were a
about
lot.
3 questions that came in, a few of them on capital gains.
Okay. So selling a home, primary residence, move to a different house, you got to have residency 2 out of the last 5 years. It doesn't have to be consecutive. It doesn't have to be the most recent 2 years, but somewhere in the last 5 years, you have to have been a residence in that home for 2 out of the last 5. And so long as that's the case, you're not going to pay capital gains.
Yep.
Hopefully that answers the question. Offsetting W-2 using passive income, yes. W-2 income is where the least amount of opportunity exists because you really are working with about 12 standardized deductions that are common to all W-2 employees. However, the dynasty strategies that I was talking to you about, those are applicable to a W-2. So if you're a high wage earner on a W-2, you've got like 12 standardized deductions and then dynasty strategies, which we could still help you with. So if you're a super high wage earner, more than happy to have that conversation with you. It looks like Danielle, thank you so much for putting the link in the chat. That makes that a lot easier as well. And yeah, Chris, I think any other questions, we should maybe just refer people, schedule that strategy call. They're open to answering your questions and kind of taking this on a one-on-one basis. But if there's anything else that's a hot button item for anyone, I'm happy to address it. And then Chris, we can jump over to that other audience.
Yeah, here's one question that came in earlier, just asking about can you take money from a non-retirement brokerage account, and then how do you minimize capital gains on that?
Yeah, so let's see, was that Yasir's? No,
That's
which
Jonathan.
question?
I have it on the screen right here.
Oh, there we go. Oh yeah, talk about how to take money from a non-retirement brokerage account in regards to minimizing capital gains. Okay, I'm going to defer to Gene on this one. This is a little bit complex. You've got a non-retirement, so a cash brokerage account, right? Trying to minimize capital gains. And that cash account, if it's a business account, you might have some operating expenses to offset your capital gains. You might have some losses in your trades. A lot of people on a year-end strategy will, take all of your positions where you have losses, and they'll sell or exit those positions at year's end. And then at the turn of the year, they will re-enter those same positions at a similar dollar value as they were in just a few days ago. But they can bank the losses in the current year and take it against their capital gains. That's just maybe the fastest way for me to touch on that. Yeah, I would recommend jumping on a call with our strategy team, and we could talk through that a little bit further. But a cash account and capital gains, that can be a little bit tricky. It'd be taking your losses where you have them, and then any other offsetting measures, costs of operating, if you're doing this as a business. If it's on an individual level and you don't have a business, I'd probably recommend marrying that cash account to an entity of some kind so that you can capture some savings.
Yeah, well put. Yeah, and I'll tell you guys, like I've actually done it myself, even though I've known a lot of these strategies. Just doing that strategy session with his team is very impressive. Definitely brings up ideas that you may not have considered, even if you've heard this stuff before. So I would definitely recommend doing that right now, and as soon as you can, because do not wait till December 25th. You will probably not likely get a meeting in. So that's why we did it this week. We were very urgent on getting this out as soon as possible.
Yeah, we appreciate the urgency, and thank you everyone for your patience early on. I was, as you probably know, with business, I was putting out a little fire, and just missed our on-time appointment here. But I appreciate everyone's attentiveness. Looks like you guys were super responsive in the chat. I wasn't really in tune with that while I was presenting, but thank you so much for being with us. TaxHive would love to advocate for you in the tax space and help you save and hold on to more of your money. And that's what I think Money Ripples is all about, is this concept of, keeping and growing more of what you have. And so we greatly appreciate it, Chris. And thank you so much to everyone being on the call and taking this time.
Absolutely. Thanks so much, everybody.
Okay. God bless you all.